In today's video, we're diving into a sector that's not just powering your gadgets, but is also driving the future of artificial intelligence. Imagine investing in companies that could potentially double your money in just a few years, all while riding the wave of the next tech revolution. Stay with us because we're about to reveal 2 semiconductor stocks that could skyrocket your portfolio, and one big name you might want to steer clear of. So before we start, if you find value in this video, please support our channel by liking and subscribing to our weekly updates. Now, let's get started. The semiconductor industry has been the backbone of technological innovation, producing some of the most rewarding growth stocks in the market. Over the past 40 years, this industry has not only transformed technology, but has also built tremendous wealth for investors who picked the right companies at the right time. With the rapid rise of AI, the stakes are even higher. AI is reshaping the semiconductor landscape, creating new opportunities for some companies while posing significant challenges for others. In today's analysis, we'll highlight 2 semiconductor stocks that are poised to capitalize on this AI-driven growth, and one well-known company that investors might want to avoid for now. Our first pick is Taiwan Semiconductor Manufacturing Company, ticker TSM, often referred to as TSMC. If you're even remotely interested in the semiconductor industry, TSMC is a name you should know. TSMC is the world's largest and most advanced contract chip manufacturer, producing semiconductors for companies that design their own chips but do not have the means to manufacture them. Among its high-profile customers are tech giants like NVIDIA and Advanced Micro Devices, AMD, both of which rely heavily on TSMC's cutting-edge manufacturing capabilities. One of the key reasons TSMC stands out is its dominance in the production of advanced processing nodes, essentially the technology that makes chips faster, smaller, and more power efficient. This expertise has translated into a highly profitable business model, with TSMC boasting an operating profit margin of 42%, significantly higher than the S&P 500 average of around 17%. This margin reflects not just the company's technical prowess, but also its strategic importance in the global tech supply chain. TSMC's stock performance over the past year has been nothing short of impressive, with shares soaring more than 82%. This growth is underpinned by robust financial performance. In the second quarter, TSMC's revenue, measured in US dollars, jumped by 33% year over year. This surge was primarily driven by strong demand in 2 key areas: smartphones and AI-related chips. TSMC is a crucial supplier for Apple, and with the anticipated launch of the iPhone 16 coupled with AI integration, the demand for TSMC's chips is expected to grow even further. Moreover, the increasing adoption of AI across various industries presents a massive growth opportunity for TSMC. As AI features become more prevalent in mobile devices, TSMC is well positioned to benefit from this trend. The company's ability to innovate and stay ahead of technological curves ensures that it remains a critical player in the semiconductor industry. To ensure you're making the most of this opportunity, keep an eye on the 50-day and 200-day exponential moving averages (EMAs) for TSMC. If the 50-day EMA crosses above the 200-day, it's a strong buy signal. Also, monitor the Relative Strength Index (RSI). An RSI below 30 might indicate a good entry point if the stock is oversold. Additionally, watch the Moving Average Convergence Divergence (MACD) for trend reversals, and use Bollinger Bands to assess volatility. Price moves near the upper band could suggest overbought conditions. Looking ahead, TSMC's stock still appears to be a strong buy. The forward price-to-earnings ratio of 25 is particularly attractive when you consider Wall Street's projections of 26% annual earnings growth over the long term. If these growth estimates hold true, TSMC's stock price could potentially double within the next 3 years, even if the price-to-earnings ratio remains the same. This is a compelling case for why investors should consider adding TSMC to their portfolios. But before we proceed, here's a question for you. If you had to bet on one industry shaping the future of tech, would it be AI or something else entirely? Comment your thoughts below. Next up is Advanced Micro Devices, ticker AMD, one of TSMC's most important customers and a company that has been making waves in the semiconductor industry. AMD has been a key player in the ongoing AI revolution, and its partnership with TSMC has been mutually beneficial, as reflected in the strong performance of both companies. AMD's stock has experienced a recent pullback, but it is still up 26% over the last year. This dip could be seen as an opportunity for investors, especially given the company's accelerating growth in critical areas like data centers. In fact, revenue from AMD's data center segment doubled in the most recent quarter compared to the same period last year, reaching $2.8 billion. nearly half of the company's total revenue. This segment is crucial because data centers are the backbone of AI processing, and as demand for AI technologies continues to surge, so too should AMD's data center business. For AMD, utilize the RSI to gauge momentum. An RSI above 70 might indicate that the stock is overbought, signaling a potential sell point. The MACD is also useful for identifying bullish or bearish trends. Keep an eye on the 50-day and 200-day EMAs to confirm trends, and use Bollinger Bands to monitor volatility. A move outside these bands can signal a potential breakout. Additionally, AMD has seen significant improvements in its client segment, which includes chips for consumer PCs. The strong demand for its Ryzen processors, which are known for their performance and efficiency, led to a 49% year-over-year increase in client revenue last quarter. This kind of growth momentum indicates that AMD is not just a company benefiting from industry trends, but one that is actively driving innovation and market expansion. AMD's outlook is particularly bullish when it comes to AI. The company's management has raised its full-year revenue forecast for its data center GPUs, key components in AI workloads, to $4.5 billion, reflecting growing confidence in its product lineup. Furthermore, as AI-powered PCs begin to enter the market over the next year, AMD's Ryzen chips are expected to see continued strong demand. Despite its high growth potential, AMD's stock is trading at a forward price-to-earnings ratio of 40. While this might seem high at first glance, it's important to consider Wall Street's long-term earnings growth estimate of 43% per year. If AMD can meet or exceed these expectations, its stock could offer substantial returns for investors willing to take a position now. Why investors should avoid Intel? Let's shift gears to a company that once dominated the semiconductor industry but has struggled in recent years. Intel, ticker INTC. Intel's story is a cautionary tale for investors, highlighting the risks of failing to innovate in a rapidly evolving market. Intel has been losing market share to competitors like AMD, and this has been reflected in its stock performance, which has lagged significantly behind the broader market. The company's second quarter results were particularly disappointing, with revenue declining by 1% year-over-year. While its client computing business posted a modest 9% increase, its data center and AI segment saw a 3% decline. This is particularly troubling when you consider the explosive growth in AI-driven demand that competitors like TSMC and AMD are experiencing. One of the most concerning aspects of Intel's recent performance is its decision to suspend its dividend after a series of quarterly losses. This move signals significant financial distress and raises questions about the company's ability to maintain its competitive edge in the future. To be fair, Intel is not sitting idly by. The company has been executing a turnaround plan aimed at regaining its leadership position in the industry. This includes the recent start of production on its next-generation AI chip, Lunar Lake, which is designed to meet the increasing demand for powerful chips in AI-driven applications like Microsoft's new Copilot+ PCs. However, these efforts may be too little too late, especially as AMD continues to gain ground in critical markets like data centers. The AI server market is a key battleground for the future of the semiconductor industry, and AMD is on track to surpass Intel in data center revenue as soon as the next quarter. Intel's strategy of heavily investing in its foundry business, a segment that currently generates about a third of its revenue, could also be a double-edged sword. While this investment might pay off in the long run, it has diverted resources from other areas where Intel is losing ground to competitors. If considering Intel, it's crucial to monitor its MACD for any signs of a reversal, which could indicate a potential turnaround. Additionally, using the Bollinger Bands can help detect any unusual volatility, which might signal a significant price movement. However, given Intel's current challenges, waiting for a clearer bullish signal on the EMA before entering a position might be wise. The comparison paints a clear picture of where these semiconductor giants stand. TSMC shines with its impressive profit margins and stock performance, cementing its position as a leader in the industry. AMD, riding the wave of AI and data center growth, is also a strong contender, showing substantial gains across key segments. In contrast, Intel is facing significant headwinds, marked by a steep drop in stock value, lower operating margins, and a high price-to-earnings ratio that suggests potential overvaluation. For investors, TSMC and AMD present solid opportunities, while Intel's struggles make it a more speculative and risk-laden choice. This detailed snapshot highlights the shifting dynamics within the semiconductor space, urging investors to weigh their options carefully. In summary, Intel's recent struggles underscore the importance of focusing on companies with strong growth prospects and a clear path to capitalizing on emerging trends like AI. While Intel may eventually regain its footing, The risks are currently too high for most investors. Instead, we recommend focusing on companies like TSMC and AMD, which are well positioned to benefit from the ongoing AI revolution and are delivering the kind of growth that can drive long-term wealth creation. Before we wrap up, let me ask you this. In the race between established giants and rising stars in the stock market, who do you think will dominate the next decade? Drop your thoughts in the comments. That wraps up today's analysis. Remember, investing in the stock market involves risks, and it's essential to do your own research and consult with a financial advisor before making any investment decisions. This video is for informational purposes only and should not be considered financial advice. If you found this video helpful, please give it a thumbs up and consider subscribing to our channel for more insights on the stock market and investment strategies. Thanks for watching Simple Investing Secrets, and we'll see you in the next video.